There are two major types of trust. There is the typical grantor trust that you can change anytime. And there are irrevocable trusts that, once done, cannot be messed with, cannot be changed, if you will. The question is, which one do you use, which one's right for you, and when do you use it? Well, good morning and welcome back to Consider This Program. I'm your host, Joe Clark.
And I am Daren Hardesty.
And for those of you who don't know, Daren is one of our associate advisors. Been with the Financial Enhancement Group for over a year now, and just a wonderful addition. We were very, very fortunate, both in 2008 when the world kind of had an economic collapse. The Financial Enhancement Group figured out how to grow, and we did the same thing through the COVID virus in 2020. Daren being one of those key additions to the team, and again, very, very happy to have you along. So we are talking about opposites attract. And this week, we're going to talk about revocable and irrevocable trusts. So I'm going to set this up and let Daren kind of knock them down. So tell me what a revocable trust is, Daren.
A revocable trust is a trust that when it's written or when it's created by the grantor, the person who's funding the trust, they are setting it up so that
Now, wait a minute. What's funding mean?
Means if you're putting any assets inside of the trust or to be owned by the trust.
Okay, so catch on to this, guys, because there's a lot of times, and we don't see it happen as much as we used to, 25 years ago, but we still see it happen. People have trust, and they didn't fund it. They didn't put anything in it, right?
That's correct.
So you've got a trust, and you've put stuff in it. That's called funding, okay?
Correct. So once it's funded, if it's revocable, which is pretty standard for most people, they set up the trust and then they expect that there's going to be changes over their lifetime. So they allow themselves to add things in, to make changes, to add amendments if needed during their lifetime before somebody or the grantor has to step down for any reason. And at that point, for different reasons, if they were to pass away or if they were to become mentally incapacitated or if they're missing, cannot be contacted, then the trust becomes what's called irrevocable.
It gets locked down. So let's walk through this and understand, because a lot of times people will say, when I put stuff in a trust, I've lost control. And what I always want people to understand, Daren, is you really didn't lose control at all. I call it the hokey pokey, right? And you're not old enough probably to remember that, but back in Muncie, Indiana, at the skating rink, we used to go to, you'd stick your left leg in and, shake it all around.
The roll arena
there we go. I guess you guys did have one in Anderson too. That's right. But I mean, that is really the deal. You can put assets in, you can pull them out. Really what belongs inside of your trust is everything but your IRAs, 401ks, things like that. Those are the assets that you really want to fund inside of that trust. The key thing being, as Daren said, irrevocable means it's irrevocable. You can't no longer hokey pokey, right?
Correct.
You cannot make the changes that are there. And this becomes very, very important that you keep the trust up to date while you still are mentally with it, while you're still capacitated, I guess would be the word, instead of incapacitated.
Correct.
Right? While you still have while you still have the ability to make those changes and to make those decisions. So, Daren, then the next question, are you required to pay taxes on income-producing assets within an irrevocable trust?
That depends.
Okay.
As most things, there's never one right answer with these things, but it depends. If you are trying to, with an irrevocable trust, there are people who have different reasons, estate reasons typically, that they'll create a trust that's irrevocable and set it in stone. And what that allows them to do is any capital gains or any earnings inside of that asset, inside of that irrevocable trust, it's not counted as income inside of that trust. So
it's not counted as income on your return.
Correct.
Okay.
So because of that, it's not producing income, and therefore there's no taxation that's due because there's nothing that's coming out or there's nothing that's being earned inside of that trust. So
that is partially. I mean, that is a fair answer. Now, I want to keep in mind as you guys listen to this and watch it, Daren and I are not attorneys. We do not play one on radio nor TV. So I want to keep it there. So if you think about it, what happens, there are two types of irrevocable trust. There is my living trust that Barb and I have that is often called grantor trust, as you used, or revocable trust. Some people still refer to them as living trust. assuming I'm still here, but I'm unable to make decisions, I'm mentally or physically incapacitated, which happens a lot more, by the way, than people just dying, right? Most of us move into that period of time. All of the income that's produced inside of that trust, even though it's irrevocable, still flows through to my 1040. Okay, still comes through, and it's still all done. Once I'm dead, if it's in an irrevocable trust, any income that is not distributed to the beneficiaries gets taxed at the trust level. So there is still taxation. It's just not going to my 1040. So what you see many times, or in the time that you've been here, are a special needs trust where you've got a beneficiary that either has got an illness of some nature or has got a challenge. Many times it's people that you've got to keep away from gambling or alcohol or hurting themselves, or there's marital problems. In those cases, those irrevocable trusts are created where you're trying to retain some of the income that's in it, but you don't want too much because, again, it's taxed at the trust level. So, again, you can have an irrevocable trust that's taxed to the grantor. Just because I'm mentally incapacitated or physically incapacitated, still flows through to my 1040. Or I'm actually dead. Now it has its own tax return. And you still have capital gains tax. You still have all of that other. But if it's distributed and you're the beneficiary, Daren, it's going to go to your 1040.
Correct.
Right? And it's critical that it's critical in your planning that you understand that.
So when the money or the assets are distributed, when it's reached that point,
Annually. Or you mean in full, in total?
In full, either way. So,
Okay.
because I know some trusts will say distribute a certain amount to certain beneficiaries over this time period, certain time period. Some it's just all at once. It's just one mass distribution. Is there a Form K-1, or does that come as a 1099 to the people receiving that beneficiary?
It depends on the asset that's in it. So a trust is not a partnership. So it's not really a K-1 per se. It is more of here's the interest and the capital gains that are attributed to your tax return based on the income that was distributed.
Gotcha.
Right. So when you look at this planning, it does become very, very complex in terms of how you do it. The type of assets that we would own in a grantor trust or an irrevocable trust where the owner was still alive would be different than what we would have in an irrevocable trust, depending on what the wishes were. Now, when you look at most of the trusts that we work with people on, when we talk about the distribution out of the irrevocable trust, in my case, it tends to be over, I suggest people do it over a 10-year period of time where they have 3 equal distributions for the beneficiary. So they have 3 chances to mess up, and you've got twice where it's not, the last 2 are not marital assets, in most situations or most cases. And again, not an attorney, not playing one on radio or TV. This is just our experience and what my knowledge base has been the 32 years that I've focused on estate planning and distribution planning. The key thing here, though, is when I say that somebody has access to a third of it, it doesn't mean that they have to take it out of the trust and go spend it. It just means they now have control over it. Okay. Right? So it does become a marital asset. They can make mistakes and they can do things like that. Now, you have on here on what is one of the most common irrevocable trust. What's that?
The ILIT, or the Irrevocable Life Insurance Trust.
Yeah. And so in that case, there is actually no cash that's involved, right? You've got a shell that has a life insurance policy. The beneficiary tends to be the beneficiary are the remainder beneficiaries. In many cases, it's the kid or somebody else. Most of these are what are called second to die, so they don't get paid until the second spouse passes away. The grantors, if you will, give money to the trustee. This is critical to make sure that you get this right. The grantor actually gives money to the trustee of the Irrevocable Life Insurance Trust, and then the trustee makes the decision to buy the life insurance, right? So you need to get the ILIT set up first, right? Then you go buy the life insurance policy, not the other way around.
So tell me about the premium.
So the premium can be paid in a lot of different ways, right? So there is a provision that I can give anybody I want to $15,000 a year. It can be my kids or it can be you. That has nothing to do with federal estate tax, right? There is a provision called the crummy provision And the key thing with that $15,000, by the way, is it's got to be hands off. I can't tell you what you have to do with the money, right? You've got to be able to do anything you want to do with it, no strings attached. In this case, I'm going to give you money, and as the trustee, you're actually going to send a letter, usually to yourself and to your siblings, because it usually is the kids who are the trustees of that, because the money is going to be fully distributed upon your parents' demise, or whoever set it up for you. The crummy provision allows that premium payment to be made as a gift of present interest. In other words, it falls under the $15,000 exclusion.
Right.
That you're able to use. So again, there's some moving parts here.
Absolutely.
You got to get the steps right. This is not one of those things that you necessarily want to go out and try on your own. Mm-hmm. A lot of mistakes happen, and what we see is many times the insurance is actually brought back into the estate because somebody did something wrong. They didn't file the crummy provision letters correctly. They bought the life insurance policy before the trust was created. A lot of stuff that can go wrong here. But here's the deal, guys. If you want to do this on your own, that is your business. But if you're looking for a fiduciary, that's our business. Give Heather a call at 800-928-4001. Get signed up for your Next Steps meeting. We'll give you the 90 minutes. We'll sit down and we'll share ideas with you that matter today, that will matter in your future. And if we choose to partner together, what FEG will do for you, and we'll put it in writing.